So you found that there are certain quantitative metrics that are highly indicative of a quality value play. And maybe to talk a little bit about that and how that differs from some of the other viewpoints out there on the...
It's become much more popular, it's voguish now largely to ignore balance sheet quality. For a company to grow very rapidly, it helps it for it to be asset light. And they might run with a very substantial amount of debt on the balance sheet, which when they're running up, that means that they run very fast and they'll go year after year performing very well. The problem is that it doesn't allow you for much in the way of, there's very little sort of ballast when you go the other way. So what I like is balance sheet strength. To the extent that we're using these statistical measures, it's not necessarily a new invention. I don't regard it necessarily as sort of, it's not like a NASA level analysis of the company. It's just, we're trying to find it's a sensible approach to doing it. But the reason we do it that way, rather than trying to be more discretionary and more ad hoc in our approach, is that we think that there are good behavioural reasons, and there's lots of research that indicates that a sort of more systematic, disciplined, quantitative, replicable approach to doing it means that through the bad times you're able to keep on functioning and doing what you should be doing, buying the right stuff. You don't swing for the fences, keep sizes of positions fairly small, consistently apply the approach, because every strategy has good times and bad times. And value has gone through a very rough time. So since the start of the year, if you track the factors that have done well, it's the factors that have done well for the last few years. Momentum's done very well, growth has done very well, value's done very badly, quality has done very badly, which is ahistorical. Typically what happens is there's a value premium. You get a little bit more performance for buying these companies that are trading at a discount to intrinsic value, and that's not been the case.
Let's talk about that a little bit. It's really, really interesting because, I'm a volatility guy, you're a value guy. And years ago, we bonded back in Santa Monica,
right.
Two completely different disciplines, but we share some things in common in the sense that value can perform during periods of market crisis.
Right.
And I'm curious for you to talk about a little bit about the history of value over the last 20, 30 years, how it performs in different market cycles, its defensive properties, and to answer this question, value's underperformed for 10 years. Is value investing dead? Is it dead, right? And to get your take on that, not that I believe that, but...
That's a question I get a lot. Is value dead? Can value come again? I don't know, but I can go back, so that we have pretty good data on value back to 1951, point in time data to 1973. There are very distinct cycles through that entire period. So there are, over the full period, the outperformance for just a simple price to a fundamental, whether it be price to book or price to cash flow, enterprise value to cash flow, enterprise value to EBITDA, even price to earnings, very simple metrics. The outperformance to the low price to a fundamental, which is a reasonable proxy for a value stock, has been massive. And the growth side of that equation, where you're paying a higher price for that fundamental, has been pretty weak. And behaviourally, you might say, well, why would you pay that higher price? It's because the very best performers have always been expensive. So Walmart, through most of the time that it was listed, was always very expensive. Microsoft has mostly always been pretty expensive. The companies that you buy that have these lower prices to a fundamental tend to be junkier companies, cyclical companies. But you get paid to hold those companies. And so, but you don't get paid all the time. You get paid over the full data series and the full cycle as well, because value performs various different ways through the cycle. From the bottom of a crash, value does spectacularly well. Value should provide some protection through a crash. At the tail end of a bull market, value looks terrible because the bid from value guys goes away. And the people who are fearless and who are prepared to pay increasingly higher prices will do very well through that tail end, but then there is some justice for those guys. There's typically a very significant crash to the momentum growth side through the cycle. There have been about 6 periods where value has underperformed materially. They're all were very well-known bull peaks. So the last one was 2000, in the run-up to the dot-com. Value performed very badly. They're all that covers, has Warren Buffett lost his magic?
So the Barron's one, right? Yeah.
And then value did then go on to perform pretty well for the early 2000s, but then it's been weak again. So it depends on how you measure value. So price to book value, that's the value factor. That's the academic definition of value. No practitioner uses price to book value, but that's the one that everybody points to because that's the one that the academics prefer because it's very simple to calculate and there are some good reasons. It's less volatile. The fundamental is less volatile where earnings is moving around. Book value is reasonably static from quarter to quarter. So it's a reasonable proxy. It really hasn't outperformed for 14 or 15 years. There are many reasons for that. Partially it's the composition of balance sheets has changed over time. There are companies out there that have bought back so much stock, they've actually got a negative book value. So it's very difficult for book value to categorize them as a value stock, even though if we would look at them on another measure, like a price to earnings, we would regard them as value stocks. So book value hasn't worked, but there's no practitioner who actually uses it. If you use an ensemble of measures that might be cash flow and earnings and sales even, that would have helped you keep up for the market for longer, but it's still failed sometime over the last 5 years. If you have some craftsmanship, which is what the more quantitative value guys describe as, their own mix that they use, where you might look at other things besides simple values. You might look at the quality of the balance sheet, the quality of the earnings. Do the cash flows match the reported earnings? Because that's important. You can have wild deviations where companies are reporting good earnings, but it's not reflected in cash flow generation. If you use all of those sort of measures, which is what most practitioners are doing, that kept up with the market and that outperformed pretty well until about the start of 2018. So since 2018, that hasn't worked very well. So that's a shorter period of time, and that's probably what most practitioners have seen, that it's been a period of weakness for value. There are pockets like that through the data series where that happens, and then immediately afterwards there is some very good performance for value. The thing that would make me nervous is if value was underperforming, but the portfolios as they're reformed at each rebalance state aren't reflecting the discount that we're seeing. But what has been happening is the value portfolios have been getting cheaper, so that the price ratios are wider. So what has happened now is that the most overvalued stocks are extremely overvalued, more overvalued than they have maybe been ever. The undervalued stocks are maybe at their long run mean, maybe a little bit rich to their long run mean. So I think at some stage, we don't necessarily have to have a crash. The cycle can just go back to value. But most likely what happens is that there's some sort of crash that resets the market. In the crash, what has happened when momentum and growth have run like this is that the downdraft has been massive for them. It's been to the tune of 80 or 90%. I think value could pull back a little bit. So I think that you want to be long short as a value guy going into the next crash to really see the outperformance, to maybe capture some outperformance on the way down, and then to be fully invested when the market finally does turn. I think it'll be a very good period for value from the bottom.